Welcome to this quick introduction to chapter 12 in the book Macroeconomics. We have now come to part 4 in the book, which is the final step in the building of our model, where we open up the economy to the rest of the world, and we do that in 2 ways. One is that we allow international trade, exports and imports of goods and services. But the second is that we also allow individuals and firms in the country to borrow from abroad or lend to foreign citizens. So there are 2 aspects. The goods and services markets are opened up, and the financial markets are opened up to the rest of the world. And this part on the open economy consists of 4 chapters. In chapter 12, we add to the model exports, imports, and international lending, international financial markets. Then we look at the open economy in the long run. What determines the development of the open economy in the long run? And then we look at the open economy in the short run and the role of fiscal and monetary policy. And here the choice of exchange rate systems will play a very important role. And then finally, there is an applied chapter 15, which looks at the history of exchange rate systems and also at the pros and cons of monetary union and the experience of the European monetary union. Okay, so chapter 12, we add exports, imports, and international financial markets. And the main themes here are the real exchange rate, which measures the price level in one country compared to the rest of the world. And then an analysis of how exports and imports matter for aggregate demand in the economy. And then we look at the financial markets. We look at the flows of borrowing and lending, which are measured by the current accounts of countries, and also on the prices in the financial markets, exchange rates and interest rates, and how they are related. And here we derive the so-called open interest parity condition. So in the macro model, we have the goods market, the financial market, and the labor market. And when we open up the economy, we're going to assume that there's a perfectly integrated goods market, so there are no customs or transport costs, but we assume that the goods produced in different countries are not perfect substitutes. So in order to export more, the exporting firms need to reduce their prices. As concerns the financial markets, we assume that they are perfectly integrated, there are no capital controls, and we also assume that investors are risk neutral, and this will lead to the so-called open interest parity condition. As concerns the labor market, we simply assume that you work and consume where you were born, so we do not discuss international migration. And once you have many countries, a key question is who owns the assets. We're going to assume that the domestic households own the capital stock of the country, and also they own all the government bonds that the domestic government has issued. This is not really central, but it simplifies notation. Okay, so we're going to look at the small open economy. And what does a small open economy mean? Well, it means that the economy is small relative to the rest of the world. We assume that what happens in the home country does not affect the world economy just because the country is so small. So what we neglect in this analysis is feedback effects. We look at one country, and if the central bank in that country raises the interest rate, that affects that country. We neglect the fact that that affects the world economy and then may have feedback effects on the domestic economy. So this analysis is of course most appropriate for small countries that have essentially no influence on the world as a whole. If you look at a large economy like the US or the Chinese economy, then of course ignoring the feedback effects is quite a strong simplification. But even if we would include the feedback effects, we would still get qualitatively very similar results. So the signs of the effects would be the same. So in that sense, this model applies quite well also to the US as a first approximation, and all models are approximations. So this means that in our model we now have two countries. We have the small open economy, sometimes abbreviated SOE, and we have the rest of the world, sometimes abbreviated ROW. And then you could ask, well, what's the model of the rest of the world? Well, if you think about it, you realize that the model of chapters 2 to 10 can be used as a model of the rest of the world, because presumably the rest of the world is essentially working like a closed economy. So we already have a model of the rest of the world, provided there is no trade with foreign galaxies or anything like that going on. So let us start with the prices in the open economy. We use P for the price index of domestically produced goods, and this is a price index expressed in terms of the domestic currency. But now we also import goods, and we let P star be the price index of foreign produced goods in the foreign currency. So the star usually means the foreign country, except when we have K star, which is the steady state capital stock. Then we have the nominal exchange rate, E, and that is defined as the price of the domestic currency in terms of the foreign currency. So when you measure the exchange rate, there are two ways of measuring it. You can define it as the price of foreign currency in terms of domestic currency, or as the price of domestic currency in terms of foreign currency. And in different data sources and different books, different definitions are used. But here, remember, the nominal exchange rate is the price of the domestic currency. So if E goes up, it means that the domestic currency is increasing in value. And that is called an appreciation. And if E goes down, it means the domestic currency decreases in value, and that is called a depreciation. And then we have the key concept here, which is the real exchange rate, which is the price level in the country compared to the price level abroad. And it can be defined in different ways. Here we define it in terms of the goods produced in different countries. And the way to look at it is as follows. If a foreigner buys the foreign good, then the foreigner pays P star for the good, or the foreign basket of goods. And if the foreigner buys the goods produced in the small open economy, then the price in the currency of the small open economy is P, but then the price of the small open economy currency is E. So the price for the foreigner will be E times P. So epsilon is now the relative price of domestically produced goods compared to foreign produced goods. And that we call that the real exchange rate. Often in the data it may instead be measured in terms of consumption baskets, but that doesn't really matter that much for what we are saying here. Okay, and this relative price, the price of goods in the small open economy compared to the rest of the world, it's going to play a key role in the analysis of the open economy. So it's a new relative price that is added when we look at the open economy, the real exchange rate. So now we look at exports and imports and how they affect aggregate demand in the economy. And we make now a simplifying assumption. We assume that imports are used only for consumption. And this is not a realistic assumption. We just make it to simplify. In practice, of course, imports are used very much for investment too, but we just make this assumption in order to think clearly about the problem, and it doesn't really affect the conclusions in any important way. So let C with a little d be the consumption of the domestic good, and let IM be the consumption of the foreign good or the imports. And let X be the exports. And then we want to analyze what determines aggregate demand in the small open economy? Well, we can see that quite easily by looking at the sources and uses in nominal terms. We looked at those in nominal terms in chapter 1 when we looked at the national accounts. So the sources of goods and services are the domestic production, which is the price index times production, plus the nominal value of imports, which is the price index of imports times the volume of imports, IM. And the price of imports in domestic currency is going to be P star divided by the exchange rate. And that's the sources of goods and services, and they are used for consumption of domestic goods, consumption of imported goods, investment, government expenditure, and exports. And as I said, we assume that for investment and government expenditure, you use only domestically produced goods, to simplify. So production plus imports is equal to total use. Well, we can rewrite this by solving the equation for y. And then we get that the total production in the economy is equal to consumption plus investment plus government expenditure plus net exports, where consumption is now the total expenditure divided by the price index. So it's consumption expressed in terms of the units of the domestic goods. And net exports is exports minus imports divided by the real exchange rate. So this here is imports expressed as the equivalent amount of domestic goods. So now, in order to determine aggregate demand, we need to determine the consumption, investment, and net exports. So the consumption function is the same as before, and the disposable income is income minus taxes plus the real interest rate on government debt and foreign assets that the household holds. And F is now the net claims on foreign households and firms that is held by domestic households. And often when we write our model, we just assume that D and F are zero. When they are not important for the analysis, we assume that they are zeros, so that the disposable income is just total GDP minus the taxes. And then we need a function for imports. And here it's quite natural that, well, imports, if you import goods for consumption, then the imports will depend on the same things as determine consumption. And that is disposable income, expected future disposable income, the real interest rate, and the amount of assets that the households have. But then also the relative price between the goods, because now in this open economy the consumer can buy domestically produced goods or imported goods, and presumably the amount that you buy of the foreign goods depends on the relative price. So if the relative price of domestically produced goods, that is epsilon, increases, then you're probably going to buy more imported goods, and that means that imports will be increasing in epsilon. Now, if you look then at the demand for our exports, the situation is analogous. For the foreign consumer, they can buy exports from the small open economy. Again, that will depend on the same factors as determine foreign consumption, but also on the relative price. So if the exports from the small open economy become more expensive, then the foreigners will buy fewer units of the exported goods. So these are the import and export functions. And we know that if we go back here, that income was equal to consumption plus investment plus government expenditure plus net exports. And to simplify notation, we write net exports as follows. So net exports is exports minus imports divided by the real exchange rate. And we just simplify notation by just including the main factors that determine net exports. And that is the real exchange rate, foreign activity, because an increase in foreign activity and income will increase the demand for our exports, and also domestic activity. So if income in the small open economy increases, that is going to increase imports and reduce net exports. So by this simplification, we get the IS equation for the open economy at the bottom of the page. And the new thing here is that we now have this net export function, which is an additional component of aggregate demand. So that's what we got in addition as we open up the economy to trade, the net export function. And what are the effects here, the signs of the derivative? Well, if epsilon increases, that means that the domestic goods become more expensive. And that is going to reduce the exports and increase the imports. So you would think that as the real exchange rate increases, net exports will decrease. Now it turns out it's not that simple. There are also some valuation effects that you have to take account of. So there's a certain condition called the Marshall-Lerner condition that is required for this to be true. Essentially, it says that the price elasticities of imports and exports have to be sufficiently large. And all estimates suggest that they are. So the Marshall-Lerner condition is fulfilled, and the picture is like it is shown here, that as domestic goods become more expensive, net exports decrease. Then in the book there are several graphs for different countries illustrating the correlations that you see in the data. You see here that imports are highly correlated with GDP growth. Similarly, exports are very correlated with foreign demand. Also, the real exchange rate and the export market share, these are often negatively correlated, as you would expect. If you look at the US dollar, for example, there have been two periods when the dollar was very strong, around 1985 and around year 2000. In both cases, as the dollar got stronger, US export market share declined. But this is not always that clear for other countries. It depends on the situation. But here it's quite clear, this relation between the real exchange rate and the export market share. So now we come to the other part of the chapter, which is the financial markets. Opening up the financial markets means opening up for borrowing and lending between countries and also in different currencies. So when we look at the financial markets, we can look at the financial flows. And the main measure of the financial flows is the current account. Because the current account shows whether the country is borrowing from or lending to other countries. And we look at the determinants of the current account, and then we look at the prices. So there are interest rates, and the interest rates are different in different currencies. And there's the exchange rate, which is the price of a currency in terms of some other currency. And we look at the relations between the interest rates and the exchange rates. And this leads to the so-called open interest parity condition. So the current account measures the payments flows to a country, and these payment flows are associated with trading goods and services, that is exports and imports, so-called primary incomes, which is wage payments for working abroad, interest payments on funds abroad, also dividend payments to the extent that firms or households in the country own companies abroad that pay dividends. And there are also so-called secondary incomes, which are transfers between countries, such as development aid. So all these activities generate payment flows. And the net balance of these payments is financed by loans from or to other countries, or purchases of financial assets. So the current account is the change in foreign net financial assets or net foreign lending. and we call that delta F. So in the model, we have no international wage payments because we assume that you work in the country where you were born. We have no dividends from abroad because the households own the capital stock in the country and no foreign capital. And we also don't have any development aid or any other transfers. And the private sector's assets are the real capital, net government debt, and net claims on foreign households and firms. So A is K plus D plus F, and if we assume quite unrealistically that the return on all assets is the same, then household disposable income is GDP, because household get the wage payments, the dividend payments, and the interest payments from the domestic firms, and then the households get interest on the government debt, and they also get interest on their net claims on foreign households and firms. And then they pay taxes to the government. So this is the disposable income of the household. So now we ask ourselves, what determines the current account? That is the change in net claims on foreign households and firms, delta F. To analyze that, we look at savings and investments of the private sector and the government sector. So we look at the private sector savings. Well, the households get GDP, they get return on their assets, they pay taxes, and they consume, and the rest is their savings. And this is used for investment. Remember that the households own the firm, so indirectly they do the investments. They also may accumulate government bonds, and they may accumulate claims on foreign households or firms. So these are the real and financial investments of the private sector in the small open economy. And then we have the government, and the government budget constraint says the increase in debt is the primary deficit plus the interest payments of the government on its debt. So if we combine these two equations, we can understand what determines net lending of the country, the current account. I will not go through these equations, but the bottom line is that the current account balance is the net lending of the country, which is saving minus real investment, which is equal to income minus public and private consumption and investment, which is net exports plus net primary income from abroad. And in the model, the net primary income from abroad is only the interest payments on the claims that we have on foreigners. So you can look at the current account balance from several points of view. Okay, so that was about the financial flows of lending between countries, the current account. Now we turn to the prices in the financial market, and that is, we look at the interest rates and the exchange rates. So we assume that the loans of the small open economy constitute a very small share of the world financial portfolios that are held by, say, large pension funds abroad. And therefore the risk involved in lending to the small open economy, because the exchange rate of the small open economy may go up or down, we assume that investors do not care about that risk. So they act in a way that neglects risk. They are what we in economics call risk neutral and simply invest where the expected return is highest. And this implies that the expected returns on loans in different currencies must be the same. So let us see what this implies. Well, the best way to think about this is to consider the situation of a foreign investor, financial investor. So someone is sitting there with a large pension fund out there in the rest of the world. And that person thinks, well, if I lend in my own currency in the rest of the world, I get the interest rate I star. So if I lend 1 unit, I get 1 plus I star next year. But if I instead choose to lend in the currency of the small open economy, well, then I first have to buy the currency of the small open economy. Then I lend for one period in the currency of the small open economy, and then I get the interest rate in that small open economy. So I get 1 plus IT at the end of the year, and then I exchange it back to my own currency at the price ET plus 1. So this is what I get if I get currency of the small open economy and lend in that currency. And now we just said that in equilibrium the expected return must be the same. And that gives us the open interest parity condition that says that the expected return is the same on loans in different currencies. And you can approximate that open interest parity condition as follows. The interest rate differential between the domestic and foreign interest rate is equal to the expected depreciation of the currency. So the intuition is straightforward. If the currency of the small open economy is expected to fall in value, then the interest rate in the small open economy has to be higher in order to compensate for the expected depreciation. So this is the open interest parity condition that relates interest differentials to expected changes in exchange rates. And this open interest parity condition has different implications depending on whether we have a fixed exchange rate or a floating exchange rate, and these are discussed in the chapter. Okay, so this chapter opens up the economy to trade and international lending. We look at the real side of the open economy. We get a new important relative price, the real exchange rate. We look at the quantities, imports, exports, and how aggregate demand is determined in the open economy. And then we look at the international financial markets. We look at the flows of lending measured by the current account and the prices and how exchange rates and interest rates are related through the interest parity condition. And there is more in this chapter. You can look at a lot of graphs showing data. There's a discussion of the globalization of both markets for goods and services and the financial markets. So good luck with your studies of this chapter, which builds the model of the open economy that we will use in 3 chapters to analyze the open economy in the long run, in the short run, and we also look at the history of exchange rates and monetary unions.